Important questions that you ask yourself when you're buying a house is how much money do I need? Well, there's an amount of money that you need to qualify and to purchase the home, and then there's the amount of money that you could invest in order to get a better deal, let's say. Let's jump in. First of all, here are the terms you use to describe money needed in a transaction. We have the down payment, there's earnest money, you'll pay closing costs and prepaids, and there's this thing called cash to close. So let's start with talking about how the money flows in the real estate transaction, and those terms will become a little more clear to you. First of all, there's two groupings: fees that you pay before closing or at the time of contract, and fees you pay at the closing, and which is pretty much everything. But let's break it down into two categories under the paid at time of contract. You've got the earnest money, which is a good faith deposit that you make in order to assure the seller you're going to follow through with the transaction. Then there are the initial expenses: a building inspection, appraisal, and credit report. These are things that you have to pay for upfront directly to the vendors at the time that you order these services. From that point forward, you shouldn't have to invest anything. Everything should be collected at the closing table, including the down payment, which is the amount of money you're going to invest into the equity when you buy the house, the closing costs, which vary slightly from lender to lender. Please watch the video on closing costs if you're interested in becoming an expert at how to understand these closing costs. But generally, they're fees charged at closing for getting a mortgage, getting the title, having the attorney close the deal, and paying some taxes. Prepaids are the amount of monies that you need to set up the escrow account and pay for your prorated share of taxes and homeowner's insurance as the mortgage gets kicked off. Then there's some miscellaneous items that may or may not be a part of your transaction, mostly homeowners association dues and other things that may be a part of your loan function. You definitely want to understand what those are before you get to the closing table. And then there's some credits. The earnest money is going to be credited back to you. The seller may pay some closing costs per the contract, and the lender may be giving you a credit based on the interest rate that you locked in at the time of locking in your interest rate. So the down payment that you're going to be investing in your home, if you're doing a VA or a USDA loan, is probably zero. FHA is probably about 3.5%, and conventional, depending on how much you're putting down, your mortgage insurance will be less expensive. A lot of people strive to put more than 3 or 5% down so that they can save money on their mortgage payment. We need to discuss that explicitly with each of our clients in order to help them make the right decision. So that's a good conversation with your loan advisor. The earnest money is a good faith deposit that's negotiated as part of the contract. There's nothing set in stone. I've had contracts that don't even require earnest money, but generally you can expect anywhere from $3,000 to $5,000 for a home in the $100,000, $200,000, $300,000 price range. The money is usually held by the closing attorney or the real estate broker, and it is credited back to you at closing. I think the best way to look at closing costs are to group them into different sections based on who's responsible for charging the fees. Lender fees vary from lender to lender. They're usually not very much, maybe between $500 and $1,500, including all of these items. If you see more than that, you're probably paying to buy down the rate. Title fees are a big portion of the closing costs. They're controlled by the attorney, who's usually chosen by the real estate agent. So even though you could shop for those fees, it's pretty difficult to do so without getting involved in asking the realtor a bunch of questions. And really, as hard as you tried, you might save $100 by shopping around. State and local taxes are, I guess you know, they're fixed. Can't do anything about those. And then there's sometimes some miscellaneous other closing costs. If you're buying a condominium, for example, there's some application fees that might be paid or a homeowner's initiation fee. Prepaid items are basically monies collected up front at closing in order to get your escrow account ready to pay the bills when they come due. And your cash to close, this is an interesting number because it encompasses some of the other things we just talked about. And it basically means how much money do I now need to bring to closing after I've paid all that other stuff. And there's a formula for it. Pretty easy if you know this formula. You take your down payment and you add the closing costs, you add the prepaid items, add the miscellaneous other items, then you subtract out how much earnest money you've given, minus any seller paid closing costs and prepaids that are a part of the contract, and subtract lender credits that are sometimes given if you take a higher interest rate. When you sum all that up, you have your cash required at closing. Thanks for watching. Hope you learned something. You can always chat with me at foundrymortgage.com.